Welcome back. Thank you so much for joining me in today's video because mortgage applications decreased last week as rates rose to nearly 7.3%. Also, it just got easier to qualify for a home loan because lending standards loosened last month. In today's video, of course, I'll share all the details, but also share some more early indications of our US housing market so we can determine which direction we are headed. Of course, thank you so much for joining me in today's video. I appreciate you. Also, if you guys want a real estate agent referral or a mortgage advisor, check out my new website, which is realestateteamfinder.com. That's realestateteamfinder.com. And of course, with that said, let's begin today's video. The first report I want to share with you guys is according to the MBA or the Mortgage Bankers Association, a weekly update I make for you guys. Just posted today, which is September 13th, and which, by the way, you guys are going to be watching this video on my birthday, by the way. My birthday is September 14th, tomorrow at the time of filming this video here. Anyways, so applications, I just realized that. Applications decreased by 0.8% from 1 week ago for the week ended September 8th. So applications overall for refis plus applications for home purchases decreased by nearly 1% last week. So the refi index decreased by 5% from 1 week ago and was down by 31% from the same week 12 months ago. Also, which is this is something I follow on the channel very closely here, the seasonally adjusted purchase index, which is an index which measures the amount of people submitting loan applications to buy houses, actually increased by 1% compared to 1 week ago. Also, it's down by 27% from 12 months ago. That really caught me by surprise because rates actually increased last week. It increased from 7.21% to 7.27%. So despite rates increasing last week, applications for home purchases actually increased slightly. Now, don't get me wrong though, I'm not saying that home buying demand is increasing greatly here because the current levels we have right now for home buyer demand is more or less on par with the lowest levels going back to 1995, more or less a 28-year low regarding that. On top of that, applications for home purchases have now decreased in 7 out of the past 9 weeks. According to Joe Kahn, who's the MBA's Vice President and Deputy Chief Economist, he stated the following. Total applications decreased for the 7th time in 8 weeks. That includes refis plus purchases, reaching the lowest levels since 1996. But purchase applications, the lowest levels since approximately 1995. Last week's decrease in applications was driven by a 5% drop in refis to the weakest reading since January 2023. Obviously, it makes sense when rates increase. Of course, we'll see fewer applications for refis here. He also says here, given how high rates are right now, there continues to be a minimal refinance activity and a reduced incentive for homeowners to sell their houses and buy a new house at a higher rate. So therefore, these high rates we have today is really impacting demand, but also on the supply side as well, because home buyers or homeowners, I should say, are not really willing to sell their houses and give up their very low rates. Something I found to be really interesting here as well, I hope this is not a trend that actually gets worse here. The adjustable rate mortgage, or the ARM share of activity, this is the share of applications in which people are using an adjustable rate mortgage in order to refi or buy a house, actually increased to 7.5% of total applications. If I recall, last year, the peak was around 12%, but the low set back in about January 2022 was around 3%. So this is something that we should pay attention to because adjustable rate mortgages are deemed a more risky loan product than a 15 or a 30-year fixed rate mortgage, for example. So what I'm curious about are more and more people getting applications for ARMs because of a lack of housing affordability. Because keep in mind, the rate for a 5/1 ARM, in other words, it's fixed for 5 years, then it's variable thereafter. The rate on that is quite a bit lower than a 30-year fix. And don't just take my word for it. Here is some data to support my conclusions here. Go figure. So for a 30-year fix, the average rate for people locking in or for people applying for mortgages was 7.21% last week. But for a 5/1 ARM, it was only 6.33%. So I would worry here that people are moving towards buying or using adjustable rate mortgages instead of a 30-year fixed because the rate is so much lower than a fixed rate mortgage. Something to keep in mind though is that the share hasn't changed too much though, because I actually look back at the report here from 1 month ago and also from 12 months ago. So to start the year, the ARM share of activity was around 7.3%. So more or less on par with the 7.5% we saw last week. Also, 1 month ago though, the share was 7%. So the share went from 7 to 7.5% over the past 1 month. So again, I'll definitely keep you posted with the latest developments here because again, this is a more risky loan product. I would hate to see this share of activity increase in the weeks and months ahead. All right, so changing gears slightly here, here's what we also know as well, because the lending standards for the entire month of August, according to the MBA, just posted yesterday, the 12th of September here, lending standards actually got looser for the month of August. So the MBA's Mortgage Credit Availability Index, or their MCAI, actually rose by 0.3% compared to July. This is indicative of loosening credit standards here. Something to keep in mind though, this is a very small increase, just like we saw regarding the increase of applications regarding purchase applications, I should say. According to Joel Connigan, he says credit availability in August increased slightly, but remained very close to lowest levels last seen since January of 2013. So big picture here, what this really means is that even though lending standards actually got a little bit looser in August, it's more or less on par with the tightest lending standards since January of 2013. This is a chart showing just that. So for the month of August, their index is at 96.6. Sounds like a radio station, but really we haven't seen levels that low going back to 2013 right there. Also, something to be aware of as well is right before the onset of COVID, let's just say December 2019 approximately, the index was almost 185. Now it's only 96.6. So lending standards have fallen greatly ever since the start of COVID. Also, when looking at the lending standards going back to June 2004, it's a joke here. I mean, look at how low or how tight lending standards are. Again, the lower the number means that lending standards are actually tighter. And of course, a high number means that lending standards were very loose. So for example, back in 2006, 2005, their index was approaching 900. Now it's less than 100. To me, my biggest takeaway regarding this is that this more or less means that lending standards were about 10 times looser back in 2005 compared to today. And go figure why our housing market imploded during the Great Recession here, of course. Let's also change gears again and talk about the number of real estate showings across North America, because I have to share this with you guys. This is quite the anomaly, to say the least. So let me just zoom in if I can. The 7-day moving average for the number of real estate showings across North America as of September 12th decreased by 258.3%. Compared to a 10.3% decrease we saw last year. Now, I kind of was hesitant to share this with you guys, but it is still on their website. When I saw that it decreased by nearly 266% as of September 8th, I emailed a showing time and I have not heard back, because I would imagine this is probably an error, because normally we see, let me just actually exclude 2023. During the Labor Day holiday week, we tend to see a decrease of home showings. So for example, August 31st last year, it was a decrease of 9.8% compared to the start this year, or start last year. But by the time we hit around a Labor Day weekend, it decreased to about 20%. So a decrease of about 10 basis points, not this giant decrease we saw in 2023, so, which again, I'm probably guessing this is an error, but if it's not, you heard it here first. And if they do email me back, I'll definitely keep it posted to see if they actually change this or if this is actually correct here. All right, let's also talk about rates as well, because average rates for 30-year fix for people with great credit, of course, according to the Mortgage News Daily, is at 7.25%. Jumbo is at 7.33%. Maybe I should make a separate video about this, but I noticed 1 year ago that jumbo rates were much lower, about 70 basis points, about 60 to 70 basis points less than a 30-year fix. Now rates are actually higher than a 30-year fix. I would imagine this is going to be impacting areas that have more expensive houses, because that's the jumbo loan territory there. In any case, maybe I'll make a video about that, but just want to point that out. Also, rates 1 year ago were at 6.28%. That's an increase of 0.97 percentage points compared to 1 year ago. Now, what's going to be interesting though is that look what happened last year. So at this time last year, average rates again were around 6.3%, but about 2 weeks later, they surged to 7.08%. And then by the time we hit October 10th or October 20th last year, rates increased to 7.37%, an increase of about 1 percentage point in about a month and a half. I mention this because what could happen in the next month or so is that the change between last year and this year actually could be negative, in which rates are actually lower this year compared to last year. And again, that's because rates were spiking at this time last year, whereas this year they are still going up, but not the same rate that we saw back in 2022. Also, as you guys all know, I like to share multiple sources of average rates, of course, as well. So according to Investopedia.com, as of September 13th, average rate for a 30-year fix is at 7.7%. I also want to discuss this with you guys as well, because this is very much an early indication of home buying demand as well. This is Black Knight's originations market monitor for the month of August, just posted 2 days ago here. So they say here that rates increase above 7.25% in August, the highest levels in more than 20 years, before setting to 7.07% overall for the month of August here. So they looked at the amount of people who are locking in rates, either to refi or to buy houses. So overall rate lock volumes, this means the total amount of loans in which people are locking in the rates for refis plus purchases. So that was actually down for the third consecutive month, falling 1.5% from July to August. Here's what I'm more focused on though. This is the purchase lock counts. So purchase lock counts are people who are using loans to buy houses that have locked in their rates. They actually look at the number of people who are locking in these rates here. So purchase lock counts were down 22% year over year. So compared to August last year, down by 22%. Also, it's down by 34% compared to 2019's levels. And the reason for this, of course, was due to high rates and, of course, the tightest affordability, or the worst affordability we've had since the early 1980s. Also, if you guys are curious who is buying houses right now, the answer, or the short answer to that, are people with great credit here. So it says here the average credit score among primary resident purchase locks. These are people who are locking in the rates to buy their primary residence. In other words, the house they want to move into actually decreased slightly for the first time since November 2022. However, it remains very close to an all-time record high. Also, Black Knight had a little bit different report to share regarding the amount of people using ARMs. It says the share of adjustable rate mortgages, or ARMs, continue to decrease, dropping to 6.56% of August's lock activity, as rate offerings for such products continue to be less competitive against fixed products. I'm curious why that differs compared to the MBA. The only thing that I came up with is that the MBA reported applications for the week ended September 8th, whereas this report looks at purchase locks overall for the month of August here. In any case, let's move on here. Let's also look at the number of people looking for homes for sale on Google, because that decreased slightly from 1 year ago. The index right now is 80 compared to 85 1 year ago. And on top of that, has been more or less decreasing ever since July this year. And lastly, let's have a look at Redfin's Home Buyer Demand Index. This is an index which measures the amount of real estate showings and other home buying services by Redfin agents. That decreased by 6% year over year, the lowest levels going back to at least the year 2021. I really wish they would provide 2019's levels as well, so we can see how that compares to pre-pandemic levels. But as you can see here, requests for home tours have been more or less decreasing ever since July as well. And with that said, please comment below with your biggest takeaways from today's video. Also, if you guys want a real estate agent referral, check out that link below, which is realestateteamfinder.com, my new website. Anyways, hope you guys got a lot of value of today's video. If you did, please hit the like button. I would appreciate that. Of course, I appreciate you. Hope you guys have an awesome day, and look forward to seeing you on the next video.